Good evening, ladies and gentlemen. Welcome to this session. Today, we are talking about trading strategy. This is a way that you're going to be checking out the markets and try to bag in some money, right? So we call it how to secure the bag. And it's a trading strategy based on a trend line and moving averages and another indicator to help you confirm the momentum that you can check out in the market. So today we're looking at the break of trend line strategy. It's me here, Mathew, and my colleague Edwin. Edwin, can I say hi?
Good evening, everybody, and welcome to today's session.
All right. Yeah. So today we want to look at trend line, a brief introduction on what a trend line is, and then go to moving averages, then a momentum. Those are the objectives. I know these are indicators we've met with, indicators we've used previously, but you see, they can look common, though with the right application and patience, of course, you can bag in something. That's what we want to look at today. So, of course, we want to look at how does the price react in relation to these indicators, how to apply these tools to spot good opportunities in the market, and of course, look at the setups with the chart. Edwin is, as always, will show us how to maneuver through and show us some examples and good setups which have happened over the past few days or the past few weeks. Hopefully, right, Edwin?
Yes.
Okay, so moving on next, what's a trend line? Of course, it's where you're joining several support levels, okay, or the levels where the price has not been able to fall below, okay. So in this case, you get support levels, you join several of them, or you get resistance levels, you join several of them. Of course, a resistance is a level where the price has not been able to break previously to the upside, okay. And that is what we're going to check out. So once we join those levels, we realize that the market is trending. Sometimes we want to call them higher highs and higher lows, for example. Like on the last slide, the previous slide. Okay, yeah. Like if we check out this one, realize that there is higher highs and higher lows. What it means is that if the price is pulling back, right, it makes a low point, but not as low as the previous one. Okay, so that's what it's called, a higher low. It's like it's making some steps to the upside. And once we join 2-3 points, right, 2-3 support levels, you can find a very nice uptrend. And that's what you use to try and find out, will the price repeat the same pattern, like following and forming higher lows, of course, in line with that trend. Okay, like you can check out there, you can see several times those levels have not been violated, but maybe towards the end, you realize that the momentum to the upside is ending, like you can see there, though. This is just an uptrend, just to be simple and clear. For a downtrend, on the next slide, you realize this is where we have lower highs and lower lows. What it simply means is that once a price gets into a resistance, okay, a high point, the next time it's trying to form a high point, then it is a lower high point. So it keeps on making lower highs. So if you get like 3 points, okay, that's what you join. Maybe 3 or 4 or even 2. Of course, you just need 2 points to draw a line. But the more the resistance points that you find or that you use to draw those levels, the better for you. Okay, the stronger it is. So in this case, several points, and then you can find it's a very strong downtrend. And the stronger it is, the stronger the downtrend or the stronger the uptrend, the more likely you're going to find a strong break if it happens. Okay, take it for instance, if there is a barrier which has been holding for so long, and then let's say, for example, it's water, a barrier which has been holding so long, resisting the force of water, and then it's just keeping on getting filled. That level is holding, the barrier is holding for so long. The moment it breaks, what happens? Breaks with a lot of force, because that momentum has been developed over and over. And that is a simple analogy you would want to use in this case. So I just introduced the downtrend and uptrend. And next, we want to go to the indicator.
But before we move on.
Oh, okay.
Yeah, just to add on what you've mentioned. So for the most part, where we have identified such a structure, ideally we would want to buy the dips, yeah?
Oh yeah, sure.
Yeah, but with this strategy, it's basically where this structure will be breached. So the point at which the momentum of the market can no longer sustain this particular structure, it's where we are looking so that we can get into a trade. So where you have such a structure, where you have an ascending trend line connecting multiple touch points, we are waiting for the market to break that structure. So we'd want to have the candlesticks beginning to move below the trend line. So with such a structure, we are looking for a sell once the trend line structure has been breached. Once candlesticks begin to form below the ascending trend line. So such a setup would give us an opportunity to sell upon the breach of the structure. Conversely, where you have such a structure, for the most part, you'd want to participate by taking sell positions upon price reversing along that resistance line, the trend line. But in our case here, we are looking for a buy setup once price breaches this trend line. So once candlesticks begin to form above the trend line, then that's the opportunity that you are trying to take. And of course, with this structure, it's a buy position.
Okay.
This is all I had to add. Yeah.
Awesome. That's awesome. So let me also add something here. It's you see, with that one now, if someone is, you see, we say that a trend is your friend until it ends.
Yes.
Now in this case, we are looking at that opportunity when the trend ends. Okay.
Yes.
So that we're looking to just get in at the beginning of a new trend when there is a break, right?
Yes.
So it means the continuation opportunities, the continuation entries to follow the trend have ended. Now we're looking into a different flow of the market. Exactly. So, and of course, you see, there are traders who want to place trades specifically based on this market structure. That's okay. That's quite okay. But again, you know, you're looking for as much assurance, as much more addition to support what you're seeing in the markets. Like, is there anything else you can confirm for me that there is, of course, a short of a different, sorry, not the short, there's a set in, or something else is setting in as compared to the previous momentum which you had. It's a down one momentum right now. Is there anything to show there's a difference or a different momentum which is setting into the markets, right? And that's why I want to combine with moving averages to get a confirmation. And of course, we've checked on moving averages before, and it's where you have a smoothing out of the movement of the prices. Okay, on the next slide. So a moving average, we have commonly used moving averages. Okay, I've got the 20, 50, 100, 200. Some people would even want to use 5, 10. So here, what matters is, are you able to test those moving averages such that you can find a crossover that works with your time frame? Okay, so in this case, we'll be using 9 and 30 exponential moving averages. The reason we are using exponential moving average and a simple moving average is the concept of we want the one moving average which will be moving a little bit faster. That is 9 EMA. Okay, and one thing about exponential moving averages is that an exponential moving average attaches more weight to the most recent candles, so it's a little bit more updated, or if you want, doesn't lag as much, right? Then we want to have another slow moving average is 30 period. You can as well test another combination, right? Like 20 and 50 or 20 and 100. Of course, you get a crossover, but you have to test and see under which market conditions, which time frame, and maybe which financial instrument do they work well. But the concept is the same. We want to combine a crossover of a moving average and a trend line. And the reason why I would want to do this, if we go to the next slide, you realize that there are times you get fake crossovers. Okay. Several times you get fake crossovers, you enter to the downside, but then you have the price getting back the momentum to continue with the trend, right? And there sometimes also you would get a break of a trend line, but still it becomes a fake one. So we are combining these two tools, that is a moving average crossover and a trend line, to filter out a fake signal from any of these. Yeah. So like in this case, Edwin, what we're looking at here is a sustained uptrend which just lost momentum at some point.
Yes.
We've got like two fake crossovers. Yeah.
Yes.
And finally, the crossover which happened on the second, on the highest, from the peak that you can see there on the chart, we had a crossover, but the downward move did not even break the trend. And that's how you filter out.
Yes.
Okay. Yeah. So someone who entered at the first crossover there, of course, they had to wait longer. They didn't get the entry at the best point. Yeah.
Yeah.
And that's the reason why when you have these two, they will help to filter out the fake indications that you can get out of any of these. Okay.
Yeah, and that brings me to the point that that's why it's quite important for one to have several confluences or several triggers.
Good. And you brought in a very strong term, a confluence.
Yeah.
And I think we should not proceed before speaking a little bit more about the confluence.
Yeah, so a confluence is a case where you'd have convergence of several signals happening back to back. So the whole idea is to have multiple confirmations, because I mean, we are trying to work with probabilities.
Exactly.
So the more probabilities, I mean, the more signals or the more triggers you get happening almost at the same time, the more likelihood that setup that you've gotten would have a high potency rate. So that's the whole idea.
That's awesome. So simply, if you're using several tools to analyze the market, if you can check the boxes, then you're having a confluence. If you can get a crossover, that's when you've checked that box. That's one indicator telling you that market is going this way. You have a trend line broken, another checkbox, right? So if you have something else also, and you can check that box, then that is a confluence. So all the indicators pointing towards the same direction is a confluence, right?
Precisely.
Oh, okay. And still, we're going to bring in another indicator to help us in checking the momentum. But before that, maybe you can, that's an example of break of a trend to the upside. And by the way, I'm getting a question here. Isaac, nice one. We're happy that you're here. We're happy to engage with you. So the question is, how do you tell that this trend will continue, or we should trade reversals only? How would you say, Edwin?
That there?
How do you know? How do you tell that the trend will continue, or should you only trade reversals? Should traders only look for reversals? I mean, what I get here is, okay, in this strategy, we are specifically looking for break of a trend, but doesn't mean that you'll have to wait for all that time up until you get the break of a trend. Remember, we are just getting in. Remember, I said that the trend is your friend up until it ends, right? So before you get that reversal, the thing is, Isaac, just look for areas that you can enter, right, to flow with the trend, or the continuation of the trend. Although we're not looking at that one today, we're not covering that strategy today. We're specifically looking at the break of a trend at a point where now it reaches that you're following, or you just getting in at the beginning of a new strategy, right? But it doesn't mean that you only have to wait for the breaks. You can as well look for good opportunities where you can enter to follow the trend or the continuation of a trend. And there are so many ways you can do that. I think it's something which we can cover another day, right?
Yeah, because I mean, the whole idea, like in this case, from this point onwards, up to this point, under normal circumstances, you'd basically look to short along the trend line, along resistance, so long as the market will retain that structure.
Because the market is in your favor, basically.
Exactly, yes, because you'd want to trade in line with direction, with the overall direction. So in this case, we would know that that structure has ended, or it's likely to sort of give you a different trajectory once the candlesticks break the structure. So for the most part, you will notice that from this point onwards, on this occasion, and on this occasion, the market or the price does not go beyond that line, that resistance line, to the upside. So price is retained below that trend line. So you will know that that structure has ended the point at which the market price or the candlesticks go beyond the line to the upside in the opposite direction. So I don't know whether his question has been answered.
Yeah, I think it's quite clear. Isaac, you can give us a thumbs up or let's know from your end. And guys, let's keep chatting. If you have any question, drop it at the chat, right? We'll be happy to engage with you. Thank you so much, by the way, for keeping it live, and having this conversation with you is always quite interesting, because we are happy to impact something. And Isaac is saying thank you. Awesome. We're happy to know we've answered you. And Edwin, before we move ahead, I think the fact that you could be trading the continuation as you're waiting for the break of the trend, it brings up the interesting thing about forex trading, that you're not only locked on the possibility of only selling, right, or shorting the market.
Yes.
You can as well, depending with how the market conditions work, then you can as well look for the opposite direction and get something out of it. Okay.
Yeah.
So before we get lost in the conversation, because getting a little bit deeper, what else do we combine with? We also need an indicator, because we're looking for confluence, just like Edwin said. We're looking for another indicator to help us check. Do we also have something else supporting? Yes, we have got moving average, you've got the break of a trend. Is that momentum either to the upside or downside enough to give us the confidence, right? And sometimes you want to give your indicators some percentage in terms of, I'm thinking about this, maybe think about it as well. Would you want to use like 3 indicators, and whichever is broken, you give them some level of, like it's giving me some percentage of confidence. Like if I get a break of a trend line, then maybe that's giving me like 10% or 15. If I get a crossover, another 15, I've got some 30% confidence. If I get an indicator, like momentum indicator being broken, also showing me a crossover, which I'm going to explain, maybe another like 15. And you can see if this confluence has happened, maybe, I'm thinking loud, also think loud, maybe giving some percentage of like 15 with 3 indicators, all boxes checked, would be like 45% confidence that I might be in the right direction of the market. I don't know. You can always think about it. Back to the momentum. It's an indicator which, of course, it's an indicator which crosses. We just put a level 100, and we want to see if it crosses above 100. Then we're talking about it should be supporting upward momentum, right? If it crosses below 100, moving downwards, it should be supporting downward momentum, right? Like you can see here. Okay.
Yeah, here is an illustration of that.
Looking at the way the market is making troughs, and swing highs, swing lows, but of most interests is that point where there are lines which you've added there. There are those points where you have the price trending upwards, okay, the price action, okay, the candles crossing upwards, and looking at the momentum, at the same time it was crossing above that 100 level, okay?
Yes.
And that's where now we're saying that the upward momentum is increasing, right? Or at the point where you're having the price strongly trend downwards, okay? Look at that vertical line there. At the same time, we had the momentum cross below 100, indicating bearish or supporting bearish momentum. And now on the next one, we want to align all of them. This was an indication just of to show you how the momentum indicator, right? It's a secondary indicator that you're using here to give an idea of the momentum where it's moving, to support what you've seen on the charts, okay? And it's always good that you don't just use this indicator alone, yeah, because you want to check, confirm the same on the primary indicators that you're using on the charts, right? Yeah. So exactly. So moving on to the conditions that you're looking out for, right? And in this case now, you want to see, of course, when a downtrend is breached or it's broken, prices close above the trend line. And then at the same time, you want to see the 9 EMA crossing the 30-day SMA, okay?
To the upside, yeah.
To the upside. So break of the trend to the upside, crossover to the upside. And then the same case, momentum crossing 100 to the upside. So everything up, 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 like you'll see in the charts. Okay, this is where now we're having a confluence, right? Crossover, yes. Up, break of the trend, up, momentum above 100, up. So bullish. Up.
Yes.
Upward movement. Look for good position.
Yeah. So ideally. Yeah, so ideally the entry for the buy would be somewhere here after confirmation of that break. So this is the momentum that you'd be targeting to capitalize on.
Exactly.
Yes.
Yeah, and before you move, just back there, before you move, to also give an idea to the trader who was asking whether you wait only for break. You see, there are those points that those areas which you've indicated there. Someone could just try and get in for the continuation of the trade just before you get a break. Because at the point where the price is exactly at that trend line and you're having the crossover, two things can happen, right? It can always be a continuation or a break. So if the continuation materializes, then of course you enter to the downside. But if the break happens, then of course you take your opportunity and run with it.
Yes.
Okay, so take us to the next one. Break to the upside, break to the downside now. And the conditions are just the same. Cross over the downside, break of the trend to the downside, momentum below 100, the downside. Just as simple, as clear as that, right? Yes. And that's how it would appear in the charts. Pretty much clear.
Yeah, so ideally, the entry for the sell is upon the break of that structure, somewhere along this candlesticks.
Exactly. Yeah. Oh, by the way, something else you can as well combine with the candlesticks, right? Because here we talk that's also even increases the confluence you're talking about. Because the pattern of the candlesticks appearing around there can as well be a strong indication to support. Because now we have the moving average, you have the trend line, we have the momentum. Number 4, you look at the price action movement or the pattern being made there. Maybe you might be having a strong engulfing candlestick, or around there might be maybe indications of rejection candlesticks or any other pattern which you're familiar with, maybe an inside bar. All that, you put them together. The more, I think, the more tools or the more tools you use or tricks you use to give you good signals or signals collectively, the better chances you have.
The more signals, the better.
The more signals, the better. Yeah, exactly. Yeah, but by the way, there is something I call analysis paralysis as well. So also if you analyze, if you over analyze, right, like you have now, because you want to get more indications or more signals, you add in Bollinger Bands, you want to put in parabolic SAR and so many other things, then you everything becomes you cloud your mind. You also want to keep it a little bit simple.
Simple,
okay? Yeah, simple, but a little bit more deep, but simple. Okay. And that's through the combination of appropriate indicators. Okay.
Yes.
Yeah. And before we move on to the next, of course, there's actually here. Hey, Boniface is saying one of the best strategies. Oh, good to know that. Actually, I've got so many people who are saying that they use MAs all the time and they work. Good to know that. And now we hope you're going to add. Yeah, hope you're going to add a little bit more knowledge so that you combine with it. All right. So next, we're moving to examples on the chart. Edwin.
Yeah. So now we'll dive into the charts. Just
that's where you play best. Give us examples. Give us examples.
Yeah.
And term confluence, another answer from another perspective. Okay, Isaac. Yeah, confluence. Of course, we talked about that one. We have questions also about MACD. Also, we have another question which is coming up. Edwin, as we're waiting for you to share the screen, looking at the conversations we're having here, quite interesting conversations. And Maungesh asking, should we wait for a few candlesticks to confirm the break of the immediate candlestick that crosses after the cross? Yes, of course. It's always good that you look at the market, the candlestick chart patterns as well, because they help in giving you more confidence, of course. And you know what? All these indicators which you're using, they are lagging indicators. Okay, when I say lagging, it means it's the price which plays fast. Okay, because they are the ones which are used to calculate these moving averages, right? So before the calculation happens, then of course the candlestick has closed already. So the candlestick pattern is indicating what is actually happening in the market as at that time. So you wanna look at it. Nice question. And now I see we have the charts. They are lagging indicators.
So it's visible from your side, Matthew?
Very clear. Very clear.
All right.
I see it's pound yen.
Yes, but towards the end of March, we had a very nice setup. So it was stretching all the way from that point, from mid-March. Then we had a descending trend line structure. So towards the end of March, we had a break.
I want to note something. You look at that strong bullish candlestick. Right?
Sorry?
Look at that strong bullish candlestick right at the break.
Yes, this particular one.
Exactly. Yeah.
Yes.
And just before that, that strong bullish, there was some form of consolidation at that point.
From mid-March. Yes.
Yeah.
So it sort of broke. Then there was a bit of consolidation. So ideally, the entry level could have been, anywhere along these candlesticks. Then you'd have that upward move.
Thank you for the clarification.
So this trade could have given you, anything between 100 to around 170 pips. So it was a very nice setup. Then today, we had 3 setups. So the first one was on pound yen. You'd have a move of up to around 300. So this structure was broken last Friday, but the largest portion of that momentum was covered today. So around 300 pips for that setup. Then the other setup was CAD yen. 3 setups.
Edwin, as you're looking for CAD yen, I see it's mostly we're looking at these setups on 1 hour. Yeah.
Yes, that's the time frame.
1 hour time frame.
Yes.
Okay. Nice.
If you look at Canadian dollar against yen, we had a very strong ascending trend line. Then if you look at all those triggers, they had already happened on Thursday. Then on Friday, towards the later part of the day, we had the break of that structure. Then today we had a very strong downward move of over 130 pips. So today we could have gotten a nice sell setup. Then lastly, we have Swiss franc against yen. Then if you look at all those triggers, they had already happened on Thursday. Then on Friday, so this is the last setup. Again, a very strong ascending trend line. On Friday, we broke the structure. Today, we got a continuation of around 130 to around 140 pips. We had gotten into a sell position earlier in the day. And those are the setups, Mathew.
They're quite clear. So
Yes.
I don't think I have much to object here, because then we might be getting to other. Because when I look at it, I see channels, I see so many other things. But today being a session where we're looking at the break of a trend and combining momentum with that one, then I think I don't have as much to add on. So yeah, but I see something here. Brian is asking, hey Brian, Brian is asking, what is the exit strategy? Good question, by the way. Exit plan, exit strategy. What should we be looking at?
And that would be hard to answer, because in some cases you might have a complete reversal, but in some cases it's just a short-term move, but it's usually quite sizable. So it's upon the trader to manage the trade. Yeah.
Okay. Maybe give in some ideas.
You could exit partially, so you can close a trade partially, maybe half of the trade, and leave the rest of the portion to run. In some cases, it's just
scaling out. That's what you're saying, right?
Yeah.
Okay. So, position trade management is a whole wide thing. But maybe if Brian was asking, maybe in simple terms, maybe where do I put my stop loss? Probably there are so many factors you want to wait for. Okay. Maybe also when you're entering, your entry will determine stop loss which you're going to use. Like in this case, maybe might want to mention that maybe wait for a retest. Okay.
Yes.
Wait for a retest, and if you get a good retest, then the previous high, like in this case, the high, if you can just show us up there, Edwin, maybe the high, the high of the previous, look at not there, after the break, right after the break, huh? Maybe would you say that the retest there could form maybe, or could be a good candidate for a stop loss, or maybe at the top there, another place for a stop loss. But then if you place your stop loss there, depending on where you entered, maybe after the retest, that's what's going to inform your reward target. Because of course, exit means either at the stop loss level or at the take profit level. Right? Yeah, and that's why this question now becomes a little bit incorporates a lot of discussion. But then, depending with your entry, that will determine the exit. Yeah, if I'm not wrong, Edwin,
yes.
Right? And the risk reward.
Yes.
Exactly. Or if you want to keep riding the trend, you might want to use the trailing stop as well. If your trade goes to the, or has already materialized the profit side, might want to use the stop loss, sorry, a trailing stop. And for a trailing stop, you might want to use a little bit higher number of points to avoid getting stopped out or getting out of the trade early. Okay.
Yes, but the other way would be to use the previous swing lows, like in this case. So like this.
Oh yeah,
can
nice
act as
one,
your
yeah.
first target.
Yeah.
If the momentum is strong, you can use the second last previous higher low for the previous trend, this one. So these can act as reasonable areas where you may find optimal exits. So the
that's true.
The most recent higher low, followed by the second last in that order. So you can use those as your targets. The momentum is strong. You can use this would be your first target, then second target, and so on. For the previous trend.
And now that you're talking about first target, second target, although I've not got that question here, but most of the times, even in my sessions, in workshops, I'll hear questions or get questions like, how do you set TP1 and TP2 or TP3? Can you place a take profit 1 and take profit? Can you place two take profits in a trade?
You're not the only ones. It's quite common.
It's very common, yeah. By the way.
Yes, so it's it would be closing the trade manually.
Basically, that's what it is. Simply, it's like marking a level where at this level I will have reached. If the price reaches this level, I will have reached my first target for profit.
Then you close a portion of the trade.
You can decide to close, and if the trend continues in that direction, then you know, well, at this level I'll be getting out with at my second target or the third target if you're lucky to get a very strong trend. So simply it's not that you're going to place like 3 TPs. You just mark those 3 levels, and then upon the price attaining or reaching that area, that's when now you want to know, how am I going to manage the position? Maybe there are people who would consider getting out and then get in. Okay, close the trade at the profit and then place another trade, right? Or maybe use a trailing stop, just like I said, okay, or something like that, or set your take profit at the farthest level and wait for it to be hit. Although that's what now it becomes a little bit risky. I see it better to combine with a trailing stop, so that if in case your farthest target is not hit, then you're protected whatever you got earlier on.
Yeah.
Okay, and Brian is saying, you guess that the previous lows and highs give better TPs? Exactly. That's what Edwin said. Eh? You're mute?
Yeah, exactly.
Okay, any more questions? I don't see any more questions. Unless you have anything to add, Edwin.
No, I have nothing to add, Matthew.
All right, but something here is coming up. Is there any criteria on the choice of pairs? I think
the whole idea is I don't like limiting myself, so I have quite a number of pairs. So I have all these tool set, both moving averages and the momentum indicator. So it's until I've gotten a structure, either a descending or an ascending trend line. So once I've gotten that, then that's when I would be keen to see when that action, the break, happens.
So basically, there is no one currency pair or one financial instrument that this is based on. Okay. Because what I think is, on any financial instrument, you have a break of a trend, or just uptrend, downtrend, and there's a point where everything is changing. Maybe check out the best time frame for a given financial instrument, but of course there are some which will form different structures, right? At some point you have a price severely giving fake signals, depending with how volatile the financial instrument is. I think there's no specific pair, but you can check out. That's where now, as a trader, you're called upon. Whenever you get a trading strategy, don't just take it like that and apply it straight away in your live account. You want to test it a little bit, see that you can use it effectively. Yeah. And that's the best way to go. Whatever side you get, test it first, make sure you're able to apply it. And severely giving fake signals. Do we wrap up that point? I think yes. Yeah. But you can Edwin? That's where now
Sorry?
I think we can wrap it at that point, huh?
Yes. So okay. Yeah.
All right, then.
And maybe you can mention tomorrow that we will have
okay. Sorry about
a session with is it David or Shanti?
Oh yeah, sure. We have a session tomorrow. It's actually US market open around 5. We have Shanti discussing about the markets. I want to see the updates as well. You get good setups here and there to help you, and be happy to see you that event as well.
Okay. All right. So with that, we come to the end of today's session, and we are glad that you could be able to join us, and we look forward to interact with you in the coming sessions. So see you then.
Thank you, guys.
Our next session.
Bye-bye. Be happy to see you.